Hello, this is James Graff with Advisors Mortgage Group with another Mortgage Minute. It's going to take more than a minute, and I'd like to first say that none of these opinions are those of Advisors Mortgage Group. I'm going to be reading an article of a writer who's full of opinions, will remain anonymous. I might interject some of my opinions. I hope I do not overstep the bounds of propriety and legality once I do so. Take everything with a grain of salt. Here we go. We're going to talk about the FHFA fee/tax that they levied of 0.5% on all refinances done through Fannie Mae and Freddie Mac. Here's the article. FHFA drops a bomb. The Federal Housing Finance Agency, I believe it is, quote, "Your refi just got much more expensive." He's talking about refinances, and he's really referring to over the life of the loan. In the short term, it's might raise your rates a little bit, maybe a quarter point, maybe. In the short term. In the long term, it could be. It is actually rather expensive. So he's correct about that long term. Next, this is from August 12th, 2012, 9:04 p.m. In what can only be described as a cash grab, Fannie and Freddie's regulator, that's the FHFA, just announced a new tax on refinances. They announced a fee. It's not. He's calling it a tax, which is correct, I think. Granted, it's not technically a tax. Here we go. It's not technically a tax, and it wasn't probably even intended to hit the pocketbooks of the American homeowner, but that's unfortunately exactly what it will do. That's correct. Let's break it down. What was announced? The FHFA, which is the Federal Housing Finance Agency, Fannie Mae and Freddie Mac's regulator, is implementing a new price adjustment for all refinance transactions of 0.5% of the loan amount. For example, $1,500 on a $300,000 loan. This applies to loans delivered to Fannie Mae and Freddie Mac in September and thereafter, starting September 1st, I believe it is. That's my introduction, which is almost all of them that aren't already well underway and locked, by the way. So the next question would be why? They're saying, the FHFA are saying, claiming, I don't know if I believe this, it is due to economic and market uncertainty. As an advisor's employee, I have to believe them. As an American, some might consider that hard to swallow because this fee didn't exist last week or last month. That's my point exactly. Economic and market uncertainty is always with us, and it applies to all markets, not just the refi market going through Fannie Mae and Freddie Mac. That is, I think, a bogus claim that they're doing it because of economic and market uncertainty. That's always here. Will be before, will be afterwards, to different degrees, according to your opinion, and in all markets, not just the refinance markets. Okay, moving on. This fee didn't exist last week or last month, but economic and market uncertainty definitely did, and it also existed in different markets, didn't it? Not just the refinance market. So what is the real reason, according to this author? Lender margins are wide. This is his opinion, and I'm not sure about that either. Their margins differ by company, location, size, quality, et cetera, et cetera, et cetera. So I'm going to move on from that. I'm not going to name names. But the size of the company and the quality of the company determine margins, et cetera, et cetera. In other words, lenders haven't dropped rates as much as the bond market would allow them to. I would interject, some lenders haven't, right? Not all of them. Maybe some have. A decision driven by necessity due to capacity constraints amid a refinance boom and an unprecedented workflow hurdles created by coronavirus rather than simple greed. So then they're not keeping their margins high because they want to make money. They're keeping their margins high because they have to pay for widening their pipe, basically, widening their. They have to hire more people to process more loans. They have to hire more processors and more underwriters and more originators perhaps to process all these loans. So it's not greed and it's not profit. It's I think it's being eaten. That margin is being eaten. So anyway, FHFA sees the wider margins, or thinks they see them, right? That's my interjection, and concludes lenders in general, I'm just, again, all lenders are different, have extra profit to spare. And I would say different lenders have different amounts of profits to spare, don't they? I shouldn't say anything more about that, should I? That money would help further the FHFA's stated goal of building capital reserves of the GSEs sufficient to end the government's conservatorship of the agencies. Let's break that down. So they're talking about capital reserves, cash. GSEs are government-sponsored entities. They're talking about Fannie Mae and Freddie Mac, basically. They want enough money to end the government's conservatorship of the agencies. Basically, they're being conserved or overlooked, governed, ruled, controlled by agencies of the government. So they want to end that as soon as possible, I suppose. I'm not sure. I don't know if as soon as possible. They want to end that, and in order to do that, they think cash reserves would help them to do that, which they think in their mind is in the public interest. That could be argued. That's in the public interest, but taking it from the public is not. Let's move on. In simpler terms, FHFA is saying to lenders, quote, "I think some of your money should be our money instead," unquote. That's the writer's opinion. Rest assured, this fee would never have been considered if rates were higher and lender margins were thinner. So I can agree with the first statement. If rates are higher, they wouldn't be thinking about this probably. They might be thinking about it anyway. It might be it's timing. But as far as margins, again, I made my arguments. Different companies have different margins and different things they do with those margins, like hire more people. The customer is paramount, so you do what you can. You spend your money to serve that customer in the best interest of that customer. That includes hiring more people when your pipe gets bigger. That's my opinion. Sorry. Rest assured, this fee would never have been considered, right? So, but since rates are so low, historically low, some of the lowest rates in history, and margins are so wide, for some lenders, I would interject, who's going to complain? Plenty for everyone, right? Plenty of money flowing around, plenty of refinances. I'll tell you who. Here he writes it here. Ultimately, homeowners. I would say not homeowners, but mortgage holders. Fannie Mae and Freddie Mac mortgage holders are going to eventually pay these fees and this quote-unquote tax. They're not even fees, they call it repricing. So it's a fee or a tax, whatever you want to call it. The mortgage community is going to get things started, right? And he says this, which is true, because at first they have loans that are locked, and they're going to have to eat that cost, 0.5 basis points. But eventually that 0.5 basis points will affect all interest rates in that sector and in that part of the refinance market, right? It's going to affect all the market rates. I think it's going to flow through the market quite quickly and affect everyone's rate. And that's the consumer's rate. That's the client's rate. So it will affect lenders in the fact that they may not be able to do as many refinances, and it will affect the clients in the fact that all of them will pay the cost. Which makes no sense to me. Okay, let's move on. Lenders have tons of loans that are already locked with expiration dates after September 1st. They're going to have to eat 50 basis points on all those loans, 0.5% on all those loans, because they locked the loan, they locked the rate. For bigger lenders, this is tens of millions of dollars in instantly vaporized profit. We could argue that, but yeah, that's interesting number. Again, FHFA's rationale is likely that lenders have excess profit anyway, which is quite an assumption, actually, in my opinion. So they can absorb this. They may have, they'll have profits. I don't know if they're excess. What does that mean? I truly hope that's not their rationale. But if it is, quote unquote, they're dumb. This is all reading from this. They're dumb. I don't think the FHA is dumb. I think they're quite clever, and they know the market extremely well. They know exactly what they're doing. Can you call them foolish? Can you call them short-sighted? I don't think so. I think they know exactly what they're doing. I still don't understand the rationale. Let's move on. Anytime regulators, which are trained and know the markets and know what they're doing, they're experts, anytime regulators jack up fees for lenders, it's the consumer that ends up paying. I'm not saying that because it sounds sensational, but because there's a consistent track record of correlation. I can tell you from my studying of economics and finance, that's just how markets work. That's economy, that's economics, that's supply and demand, that's tariffs, taxes, all get passed almost entirely to the consumer. And down the line, eventually they get passed entirely to the consumer. Tariffs, taxes, fees, all end up in your price tag. It's price of doing business. It can be occasionally it can be shared, depending on the market and the causes of why they're shared. But in vast markets like mortgages and products, they're not shared. You just simply pass them on to the consumer, basically. Not entirely. Like I said, I think the 50 basis points will end up being less than a quarter of a point adjustment in rates in the short term. I don't know the long term. No one knows the long term. So that's my opinion. In fact, lenders are already sending out reprice notifications to raise rates for those loans still eligible to lock today. So they're not locked yet. They're sending a reprice. The reprice is coming from the market. It's coming from the market. I'm sure the market rates are driven by this new announcement. In other words, it's not already locked. If it's not already locked, your refinance just got hit for 0.5 points. That's incorrect. I would say that's not true. I would say that it'll get hit for much less than that, probably a quarter point in the short term. In the long term, I'm not sure. It may equilibrate to 2.5 points. I really don't know. He's full of conjecture. So am I. These are all guessing. We're all guessing at this point. But we saw bond prices and bond rates jump after the announcement. I saw it. Everyone saw it. Anyway, sorry. Does this affect purchases? No. You're in luck there. FHA's explanation, however, is further out of luck. Think about it. Why would, quote, market and economic uncertainty, unquote, affect refinance mortgages and not purchases? I totally agree. That's just bogus. That's foolish. They can say it. They must have a reason for saying it. That's so that people will buy it. So they're making a statement that's clearly, I would say, I personally say false, but they're making it so that people will, the vast majority of people say, okay. And they'll say, yeah, they're so sure. People that don't understand markets will say, that makes sense. But it doesn't make sense. And he says, I'll tell you why. Many lenders currently have higher rates for refis versus purchases due to the insanely high refinance demand. And this is true. I've seen this. They stopped taking refinances. They jacked the refinance price up so high that none of them come through their desk. They don't want them. They can't process them. They don't have enough. They're not going to change. They're not going to affect it. They don't want it to affect the quality of their business. So they're actually semi-rejecting these refis by pricing them so high. You really want a refi? I'll do it for you, but it's going to be expensive because I don't have the personnel and the time to dedicate to that. That's my opinion. This is what I'm thinking in my head. This is a picture I see. I don't see it for real, but I do see that. I did see the rates on refis go up, and from certain companies I cannot name, and I did see that some of them were simply flat rejecting them. I'm not sure how they did that. I think they were just repriced them. That's as far as I remember. They were repricing them in order to keep the flow low, which is perfectly legal and understandable from a business standpoint. Moving on. Those higher rates mean lenders have higher margins and more profit on refis. I don't see the profits. They have to, if they have to process so many of them, they may have extra costs, or they may have extra profit. Can't be said. We can't say that. More profit that the FHFA would like to take. Now, in the FHFA's mind, they probably see profit. I'm telling you that profit that they see, some of it is fictional. Anyway, moving on. Again, they'll take it from the lenders at first, but eventually it'll be taken by the consumers, which is, to me, against all common sense. The Fed, the government, Government agencies are all trying to avoid foreclosures. They're trying to help people with mortgages, to avoid foreclosures, to help people that are about to be evicted in order to avoid foreclosures. Again, it doesn't make sense. Is this as bad as it looks? He says, yes, it's a bitter pill to swallow and a very low-class move, given the issues facing society at the moment. It's pretty much what I just said, right? Granted, the FHA likely doesn't see it that way. The FHA sees quite well, in my opinion. They're experts. They know what they're doing. They've been in the business long enough. They know what's going on. Why they're doing this? They have their own motives. They think it's in the public's best interest for the Fannie Mae and Freddie Mac to move away from government agency conservatorship. And they think now's the time to do it, or maybe that's just happenstance that it had to be done. They had it scheduled to start now, so they're starting it now. I don't know. So they likely don't think or believe they're taking money out of consumers' pockets. I can't buy that one. Of course, they know they're taking it out of consumers' pockets, but years and years of past precedents prove that's exactly what's about to happen. I would agree with that. There's many studies that prove that the taxes and tariffs are mainly foisted upon the consumer client. So, is there anything I can do to avoid this or make it better? No. It's the government. It's a repricing, which is really a fee or tax. And he says they're the government. They're here to help. That's sarcastic, I guess. But so the main point is that I would argue that in their mind they are trying to help. They think that taking the conservatorship, the governorship, away from the government and making Fannie Mae and Freddie Mac more independent, they need cash reserves to do that. They think that maybe they had it already scheduled to do it now, or now is the opportune time to do it. They felt if you can afford to refinance, perhaps they're thinking we can take it from the consumers as well. But they don't say that, do they? I think they know full well they're taking it from consumers, but they may be thinking in the back of their heads, these are consumers that they can afford to take it from, and that's a mistake. Because some of these consumers are on the border and may end up not being able to refinance, and then may eventually down the line end up foreclosing. That's my thought, and it's an ugly thought, in my opinion only. Again, not the opinions of Advisors Mortgage Group, which brings you this Mortgage Minute. The opinions here are basically the authors of this article and mine. I tried to keep my statements as honest and truthful as possible. I'm an American, and I have to serve the clients and customers with truth and honesty as much as I can, so that they can make decisions that are in their best interests. And with that, I'd like to thank you for listening thus far, and I have to hope that you have an absolutely fantastic day. Thanks again.